This is an analysis from Alpha Business Media. What we're looking at today is a fundamental shift happening in Nepal's economy. You've got a 20th century banking model colliding head-on with a 21st century reality. And right in the middle of it all, artificial intelligence, which is pretty much set to decide who wins. Let's dive in.
So let's start with this one question. You hear it in thousands of bank branches every single day. On the surface, it sounds like a responsible thing to ask, right? But it's actually a relic. It shows a deep misunderstanding of how value is even created in today's economy.
And this isn't just a small hurdle for a few startups. This obsession with physical collateral has become a major systemic bottleneck. It's the primary thing holding back the most dynamic, most exciting parts of Nepal's economy.
To really get our heads around this huge shift, we're going to walk through 5 key areas. First, we'll look at the problem, what we're calling the Great Collateral Prison. Then we'll explore the AI-powered solution that's emerging. We'll analyze the disruptive power of Fintech, lay out the 2 very different futures for the banking sector, and we'll wrap up with the big strategic choice facing industry leaders right now.
Okay, so the core problem is this. The current system isn't just a simple preference for collateral. It's become this deeply entrenched prison that basically dictates who gets money and who doesn't.
The banking system is still playing by the old rules of Jitto, physical collateral. And look, that model made sense back when information was hard to come by. But today's economy, it runs on a completely different kind of fuel. This constant, rich stream of digital data coming from platforms like PhonePe and eSeva. The 2 systems are basically speaking different languages.
So who gets left behind in all this? It's not just a few businesses here and there. We're talking about entire segments of the economy. Think about software companies whose biggest asset is their code, or digital marketing agencies with steady, recurring revenue. Female entrepreneurs who, because of how our society is structured, are just less likely to own land. Young innovators who don't have inherited property. The system pretty much excludes anyone whose value isn't tied to a physical piece of paper.
And this is the most crucial point. The problem isn't that these new businesses are too risky. The problem is that the bank's tools are just too old. They don't even have the right lens to see these profitable, growing businesses in the first place. It's a failure of perception, not a problem of risk.
So if the problem is a failure of perception, then the solution has to be a new way of seeing. And this is exactly where AI enters the picture, not as some futuristic buzzword, but as a genuinely revolutionary economic tool. The most powerful use for AI in a market like Nepal is something called alternative credit scoring. It's a totally different way of figuring out who's good for a loan. Instead of demanding land titles, it analyzes the digital footprint that a business leaves behind every single day.
So how does it actually work? Well, it's basically a 3-step process. First, the AI engine just sucks in massive amounts of digital data. Second, it uses machine learning to find these hidden patterns and connections in the data, things that signal a business is financially healthy. And third, it generates a score. But it's not a simple yes or no. It's a probability of repayment. This turns lending from a gut-feeling decision into a sophisticated, data-driven science.
And what kind of data are we talking about here? It really falls into 3 big buckets. You've got transactional data, the financial lifeblood of a business, all visible through digital wallets and payment platforms. Then there's behavioral data, things like customer reviews, or even how healthy a company's suppliers are. And finally, you have utility payment data, a super simple but powerful clue about financial discipline. You put all that together, and it paints a way more accurate picture of a business than any land deed ever could.
Now, a powerful new technology like this needs a vehicle to get into the market. And it's pretty unlikely that vehicle would be the traditional banks. Instead, it's a new generation of nimble, tech-first companies, the Fintechs.
You see, this all comes down to a fundamental conflict in corporate DNA. The big banks are built on these huge legacy systems. They have a culture of avoiding loss at all costs, and their whole identity is tied to tangible things. Fintechs, they're the exact opposite. They are tech companies first, they have lean operations, and for them, data is the most valuable asset. They aren't trying to jam AI into an old system, they're building a whole new system around AI.
And this is the Trojan horse strategy. Fintechs are going to use AI-powered credit scoring to offer a way better loan product, unsecured, fast, and easy to get, to this massive market of small and medium-sized businesses that the banks are just ignoring. But once they get that customer relationship, they won't stop with loans. They'll start cross-selling everything, payments, payroll, you name it. The loan is just the first move in a much, much bigger game.
This brings us to a huge inflection point for the entire industry.
The choices that banking leaders make over the next, say, 24 to 36 months are going to determine their entire future. This competition between the old guard and the fintechs isn't leading to some happy coexistence. It's leading to replacement. Two very different paths are opening up.
So there are two starkly different futures possible. The first is what we call painful adaptation. This is where a few banks really struggle to keep up, but most of them just fade into irrelevance, serving only a shrinking elite. The second, and honestly more likely path, is disruptive substitution. In this future, fintechs just completely bypass the old system. They capture the entire high-growth SME market and leave the legacy banks behind to just manage existing wealth.
So here's the real takeaway. The biggest danger for banks isn't that their technology will become obsolete. The real danger is that the market will simply move on without them. They risk becoming strategically irrelevant to the most important, fastest-growing part of the economy.
And that leads us to the final unavoidable choice. This isn't some theoretical exercise. This is an urgent call to action for both the leaders of the industry and for policymakers.
The single most important step that regulators can take right now is to create what's known as a regulatory sandbox. Think of it as a controlled environment for innovation. Essentially, a sandbox gives banks and fintechs a safe space supervised by the Nepal roster bank to test these new AI-driven models on a limited scale. It's the key to unlocking innovation responsibly, making sure everything is fair and data is protected while moving the whole system forward. Without it, the current rules will only protect the past, not build the future.
Which leaves us with a final, very direct question for every single banking CEO in Nepal. The choice is no longer if your collateral-based lending model will be replaced, but who is going to replace it. Will you have the courage to proactively cannibalize your own outdated business, or will you just sit back and wait for the disruptors to do it for you? The clock is ticking.